Participants, good morning. Thanks for joining on a Saturday morning, and this is a long weekend. Now I have got hold of Suraj between the weekend because everyone is going out for the 3 days, May 1st, Friday, Saturday, Sunday. Anyway, nowadays fund houses are coming out one by one with SIF, which is a specialized investment funds, where the minimum ticket size for investment is 10 lakh rupees. Currently, Tata Mutual Fund is launching their SIF product under Titanium brand. They have already one fund, hybrid long short fund. So now they are coming out with equity long short fund. In SIF, there are 7 investment strategies. Tata Mutual Fund's brand is Titanium for SIF. So Titanium is launching their second offering, and it is in equity long short category. We have Suraj Nanda, the fund manager of Tata Mutual Fund, who is in charge of SIF, all SIF investments right now. So this is the second offering from them. In this session, he will help us to understand SIF in general and equity long short category in particular. To talk about Nanda, he is an experienced long short fund manager because in the country there are very few long short fund managers available as we speak. So the industry has to grow. Mr. Nanda is an experienced long short fund manager who delivered strong, low volatility, risk-adjusted returns in his previous assignment at ICICI Prudential AMC. So he was there for about 9-10 years, and he has handled the long short strategies there in the AIF portfolio. Prior to that, he has worked with IBM India as application developer, and from IT to you can see a lot of mechanical engineers in previous 20 years back or 25 years back, a lot of mechanical civil engineers coming to finance management, and now we have an IT person who has moved to financial management. Welcome, Suraj, to our channel, and thanks for accepting on a Saturday our invitation to share your knowledge with our subscribers. Now I welcome you.
Thank you, Chokaling.
Yeah, sure, Suraj. Probably we'll get into some of the basic questions which are very preliminary. This session is intended to make people to understand what is SIF. Is it necessary for them? Should they go with it? Does it have higher risk? All those things, all basic questions. So, and SIF is also known as the specialized investment funds, are still a new product to many investors. For a layman, could you please explain what is SIF?
Yeah, so see, SIF, if you see, like Choka said, specialized investment funds, the objective of this category, if you see why it has been introduced by SEBI, is to give a better risk-adjusted returns for the investor. Because if you see any long-only product, which we have on the mutual fund side, obviously all these products, do very well when the markets are in a bull phase. But markets are not linear. We have seen that over the last 2 years, it has been, pretty volatile, flat. There has been multiple newses of, tariff war volatility which came, then trade deals, then war. When you have that kind of a volatile environment and you have drawdowns in the market, a long only product cannot protect your downside, right? So that is where, an SIF kind of a strategy comes into the picture, where it is able to capture the upside like a long only, but it can protect the downside for the investor by using the instruments which SIF as a category allows you to use, right? So in that way, what happens when the markets are in a bull phase, you are able to capture 90 to 110 or 120% of the upside like any long only product. But when valuations become very extreme, for example, in that kind of a scenario, you are able to reduce the risk. So the objective of SIF is to manage the risk for the investor very well over the market cycle. So that is how, SIF as a strategy is used. And if you look at different products also, you'll understand that all these products complement the products on the mutual fund. If you look at a hybrid long short fund, it can be positioned as an arbitrage or an equity savings, or the way we have positioned it more like a BAF plus If you look at an equity long short, which we are launching it more like a flexi cap plus. The reason we are doing it is because if you see a long only product, net equity is always between 90 to 100% at every valuations of the market. And that is what, this product will solve, that when the valuations become very expensive, it is able to reduce that risk for the investor by reducing the net equity. And as a result, what happens, you are able to capture 100, 120% on the upside. But when the markets fall, you fall less than the market, right? And as a result, over that 3-4 years, the product looks very good on risk adjusted returns, over the cycle versus a long only product.
Okay. I mean, I can today morning I was discussing with your sales team, Tamil Nadu head Santosh, and he mentioned already you have a product in the hybrid category, hybrid long shot.
Yes.
So in that he was giving me a short snapshot. Since the launch of the product of your hybrid long shot, the market has corrected 8%, minus 8%.
Yeah.
And your BAF, balanced advantage fund, has corrected 4%, minus 4%. Whereas your SIF, that hybrid long shot, has corrected only 0.4%.
Yeah. Yes.
That is the kind of protection that you are offering. When market is down 8%, your product is able to offer almost plus 8% kind of thing when compared with market. So that is one thing. And the other is, you mean long only. Some of the people, some of the attendees may not understand. It is you mean to in mutual funds, they always stay invested whether the market goes up or down. I mean, right? So that's what you mean by long only.
Yes.
Whereas
yes. So what I meant is that any mutual fund product, be it a large cap, mid cap, small cap, multi cap, flexi cap, you are almost fully invested in equity at every valuations, whether you are entering into a bull market or you are entering into a bear market. The only thing you can do is increase the cash in the fund to some extent, right? But that doesn't protect you significantly on the drawdown, because if the market falls 10-15%, you are also falling roughly around that range in a mutual fund product. Whereas in this product, you are able to reduce that risk significantly, and you can fall 40 to 50% of the market.
Okay, good. So that is one of the protection that is offered. So then why, I mean, the reason, what are the other advantages? One is that you are saying, okay, it protects downside, SIF protects downside unlike mutual fund. Right. But what are the other advantages SIF offers?
See, the other advantages which it offers is that the usage of derivatives in a sideways markets. Okay, so see, when the markets are flat, like what we have seen over the 2 years, a mutual fund product finds it difficult to generate returns. And that is why if you see the rolling returns over the last 2 years, it would have become almost flat like the market. Whereas if you have an SIF kind of a strategy, you can use the derivatives which is allowed, right? Using it as a paired long short strategies, or using it for thematic longs, thematic shorts. Like for example, if you look at a few sectors which have corrected due to the AI disruption, right? Let's take the example of IT as a sector, right? In a mutual fund, if you want to be underweight, the maximum weight or the minimum weight you can go to is 0%. Right? You cannot go below 0%. Whereas in SIF, we can take that call to go to a negative weight in the sector and make money out of it. Right? So that is the kind of advantage in a very simple way, which this kind of a product, does for the investors.
Okay. So even in a down market, you can generate some returns.
Yes.
Yeah. Okay. That is a great advantage for many investors. I mean, earlier, these kind of products were not available to Indian investors. I mean, unlike developed markets like US or somewhere else, products were not, because when people say that when gold goes down, for example, just I'm taking an example, when gold goes down, I'm not able to make money.
Right.
When it goes up, because I have bought gold, I will make money. But when gold goes down, I don't know how to make money. Now, you guys are here when market goes down to make some money. That is a good news.
Yeah, yeah.
To some extent, of course. And then it leads me to the next question. Since this SIF is a new product completely, should it form part of everyone's portfolio? Do you recommend? In general, I'm asking, for a normal investor, is mutual fund alone is enough, or it is better to have some portion in SIF kind of product?
See, I think in India, no, like you said, in developed markets, these kind of products are there, where you are able to give a better, risk-adjusted returns to the investor. What do I mean by risk-adjusted returns is that, see, what is the return you are generating for a unit of risk you are taking? Okay. The thing is, these kind of, the risk-adjusted return as a objective is very significant in a developed market. Whereas in Indian market, we only talk about returns, right? We don't talk about the risk which people are taking. And that is what, an SIF as a category is trying to solve. Because as the markets become more developed, you need these kind of categories to, manage the risk or the volatility for the investor very well. Now, let me give you an example. For example, an investor, if he enters into a long only or a mutual fund product, if he is entering in 2024, you'll understand that the IRR for him will be low, right? If he is entering into a mid cap and a small cap fund. Whereas if he is entering into a mutual fund product, when the markets have corrected, his IRR will look high, right? So timing matters very significantly if you are in a mutual fund product, because if you enter at the peak of the market, your returns will look low, right? For a good considerable amount of time. Whereas in a SIF, like a category, what happens is if even if the investor is entering in 2024, you have automatically reduced that risk of the portfolio during that period because of the valuations to a net equity of 30-40%. And as a result, even if he enters, the drawdown will be lower if the markets correct, right? And when the markets have corrected, you have automatically increased that risk for the investor significantly so that he can participate on the upside. So what happens with this kind of a product is your, the volatility for the investor is very smoothened. He doesn't need to worry about the timing of the markets, and he can, keep on investing with this kind of a product to, get a better risk adjusted return with a lower volatility over a 3 to 4 year period.
Good,
So I think it's a good addition to the portfolio because generally the investors benefit in the bull phase in Indian markets. But when the bear markets come, you're not able to protect the downside. This product is there to protect the downside when you are in a volatile markets.
Okay. No, that is good. That is good. And in that case, you mentioned that risk-adjusted returns are good, and generally it reduces risk, and even during flat market, it makes some money. All those things, taking all these things into account, what would be the suitability of the product? Who can consider? Senior citizens, or conservative investors, or youngsters? Who all can consider this kind of product?
See, I think this product has to be considered by everyone. Obviously, senior citizens, given their risk, the amount of risk which can they take is lower. So for them, it suits very, very well, right? Because you're managing that volatility for them very well in this product. But like I said, even for a young to a senior, everybody can have this kind of a product. Because see, on the upside, when the markets are bullish, it's not that we are conservative during that period of time. Our net equity at the top will also go to a 90-100% like a mutual fund product. It is when the valuations go to extreme, we reduce that risk in the portfolio, which a mutual fund cannot do, right? So it fits in the the investment portfolio of everyone. But if you just ask from the risk perspective, which I know a senior citizen cannot take the amount of risk which a young citizen can take, it fits very well into their portfolio, but it should be part of the portfolio of every investor.
Okay, good. So so nowadays, now the like in shampoo, like in eatables, like in biscuits, we are getting a lot of options. Indians, consumers. similarly, investors are also getting more options nowadays to investment, for investment.
Exactly.
That is good news. More thing, I'm not sure about the regulator SEBI, whether they are prescribing this product as a higher risk product than mutual fund, but does it carry higher risk than a normal mutual fund?
See, I would say the risk in this kind of products are lower versus the pure play mutual fund. Like I said, the objective of this kind of a category is to give a better risk adjusted returns, and that is why all the products, like I said, complement the products on the mutual fund. I will give you an example. If you see equity long short, we are positioning it like a flexi cap plus. That means what we are saying, it is going to give you a flexi cap plus type of returns, maybe a +1 +2, but with a lower risk, because you're managing the downside very well, right? And similarly, if you look at, for example, X top 100 kind of a product, which caters to mid cap and small cap funds, and in that product also you can manage the downside risk better, right? If you are in a 2024 kind of a period when mid cap and small cap are at their peak, a long or mutual fund product cannot protect your downside. Whereas if you are in that kind of a product, you can reduce the net equity and protect the downside. So the thing is, it's a misconception that because you have derivatives in SIF, the risk is higher than a mutual fund. I would say the objective of SIF is to reduce the risk for the investor over the cycle, right? To give a better risk adjusted returns.
Understood. Now you have already come out with an NFO, and it is in the market right now, new fund offering, which is equity titanium equity long short fund. So this, in simple terms, could you explain what you will do in this fund from a product perspective or investment perspective?
Yeah. So, like I said, the positioning of the fund is a flexi cap plus positioning with a lower risk, and the product is structured in a way: if you have 100 rupees, 75 rupees will be your cash equity, long only, fundamental long only portfolio, and the remaining 25 will be kept in a money market instrument, so that we can use it as margin for the derivatives, right? And using that derivatives, we will be moving that net equity in the product from 0 to 100, right? So when we think that the valuations in the market are cheap or fair, let's make it very simple. In the case, for example, market valuation multiples is between 15 and 21, 22. Our net equity will be between 85 to 100. So that means if I have 75 cash equity, I'll be taking a 10, 15 or 20% net long using derivatives to go to that 85 to 100, right? And when the valuations of the market, for example, goes to 23, 24 and above, we will be, if you look at the past history, in that case, you have to reduce that net equity, because the valuations are running ahead of fundamentals. So we have to reduce that net equity. So in that case, our net equity will fall to 60, 50. If it goes to 24 and above, like in September 2024, will go to 30, 40, 20, right? So in that case, with that 75 cash equity, the net short on the derivatives will be 20, 30%. Right? In that way, we'll be reducing that net equity. So what happens is that with this product, what happens, like I said, when the valuations are cheap or fair, our net equity itself is like a long only product. So we will be also capturing, 90 to 120% of the upside, right? And when the markets fall, automatically we have positioned it for that, risk, and reduce that net equity. And we should fall 40 to 60% of the fall of the market. And as a result, what you see, if I do a very simple math, in a bull market, if the markets are up 20%, you are capturing, 18 to 21% of the upside, right? And if the market falls 15% in a bear market, you are falling only 7%. And as a result, you'll see markets are up only 5%, but you are up 12, 13%. So in that way, you are running the product where you have reduced that volatility. And as a result, because you captured significantly on the upside, you're falling way less, right? At the downside, and you give that output.
Okay. So this long short strategy, and I mean, even though it will give you more like a flexi cap return at the end, but with lower risk, in the sense when market goes down, your returns will not go down to the same tune. Similar to
Exactly.
So it is for little less risk in the risk averse investors. One, it is good product. Second, everyone wants to have the same return, but with when market goes up, I get the full return. When market goes down, I don't go down that much. So that way, there is definitely a better product. Everyone would love to do that. When let me get the full upside, but at the same time reduce my downside. That is a good thing. And do you have any particular significance to introduce this product at this point of time?
See, I will tell you, because see, in December we launched hybrid long short. At that point of time, markets were at a very fair valuations. Nifty was at around 25, 26,000, and we found it a very fair valuations kind of a market. So we, launched a product which focused more on asset allocation, because in hybrid long short, you have a very significant debt, which is 25, 30%. And then on top of it, you can manage that equity part dynamically, like a BAF product. Right. And given that, over the last 3-4 months, like you said at the beginning, markets have already corrected 8-10%, at least the headline numbers. Right. But if you look stock specific, a lot of stocks are down 10-15-20%. Right. So I think at this point of time, when the crude is at its peak, and obviously the geopolitical, risks are very high. So I think in this kind of a scenario, when there is so much pessimism, you can launch a product which is more aggressive versus what a hybrid long short was. And result, we are launching an equity long short, which is more equity oriented. There is no debt in this kind of a product, and we wanted to, participate also on the upside when these kind of risks kind of settle down. So I think it's a very good period, because it's a higher riskier product than a hybrid long short, but gives a better risk adjusted returns versus a flexi cap product. But one has to remember, see, it's not a post COVID kind of a phase where you have a 30, 40, 50% rally in the markets, right? Because even after 10 to 20% returns in the market, you will again be questioning whether the valuations are ahead of the fundamentals. So in that kind of a scenario, and we are in a markets where it will be volatile, right? Because of now after Iran, I don't know whether it's over till now also, because ceasefire still goes on still there. But then you will have Cuba, then you'll have Greenland. So there are, see, the markets continue to remain volatile till the person is there, right? So in that kind of a scenario, you need to have a product which gives you that volatility management better than a long only.
Correct. I mean, you rightly said this is a good product for Trump G. For Mr. Trump, until he is there, markets might be volatile. We don't know. As you said, today.
See, you can see it over the last 1.5 years now, right? Since the Liberation Day, markets have been very volatile. So it becomes very difficult in that kind of a market, to be just with the long only and have that confidence, that with the volatility. So I think the product gives you that protection in the volatile markets, and as a result, the investor is also able to sleep, peacefully.
Good. Yeah, true. That is true. And most of the time, investors ask is, okay, you are reducing risk. In that case, will the return go down? So what is the approximate return? I mean, anyway, you cannot guarantee. No one knows what the return will be. Markets are subject to risk. All those things we all know. But what is your what an investor can expect and invest in this kind of offering?
See, we would say a Nifty plus 3% kind of a product with a lower, volatility than Nifty. If you look at the volatility of Nifty, that is around 14%, right? In this kind of a product, it will be around 11, 12%. So it is anyways lower. Now, like you said, there is a possibility that you miss on the upside, right? Because markets behave like a pendulum. It is not that if I see valuations are stretched and I reduce that net equity or risk in the portfolio, market is going to fall tomorrow. It will never happen, right? Similarly, when the markets fall and we want to buy more in this kind of a fall, we don't know market is going to go up tomorrow. It might fall another 5%, right? So in that kind of a scenario, what happens is that there is always a gray period, right? When the valuations will go plus 2 standard deviation above mean or become very expensive, but you have to manage that risk on the downside, because a bull market has 3 phases. There is an early phase, there is a middle phase, and then there is a fag end when the valuations are running ahead of fundamentals. So in that kind of a period, you will have to manage the risk downwards. And you will remember that in 2024 post-elections, when the valuations were running ahead of fundamentals. So in that kind of a period, no, when I was managing enhanced dynamic equity fund, I was reducing that risk in the portfolio. But for 3 months, it was a painful period because the markets kept going up and we kept reducing the risk. But it paid off from October to Feb, when we didn't fall much as the markets. So one has to be patient, because see, once it can be a 2-3 month period when the markets keep going up or keep going down, right, when you are reducing or increasing the risk. But when it moves up or down later and it falls into that risk management which you have done, you will automatically capture it on the opposite side, and it will look better. So that is why I say the time horizon for this kind of a product is a 3 to 4 year period. Now, one should not compare how the product has done in a bull market or how is it done in a bear market. What the output you will see is a 3 to 4 year period where you will see a Nifty plus 3% with a lower volatility.
Very good, very good. Yeah. That was my next question. I now suggested holding period. You answered 3 to 4 years minimum for this kind of product.
Yeah. Because then you see the entire market cycle. You will have a bull market, you will have a bear market, you will have a flat market. If you see the last 3-4 years, you would have seen all the three.
True. And how about the taxation? It's same as.
So the taxation in this product is equity taxation, LTCG after 1 year, less than 1 year STCG, like any mutual fund product.
Sure, 12.5%. That is fine after 1 year. And couple of questions before we get into Q&A. The thing is, if market goes down, just for a layman, let us assume Nifty goes down 20%.
How much?
20.
Okay.
20% How much this product, this the equity long short product, titanium equity long short product will go down approx?
See, like I said, when the markets are in a down phase, we'll be down 40 to 60% of the market, right?
Okay.
So that means we will be between 10 to 12% of the downside.
Okay. So out of the 20%, probably you will be able to protect the 8 to 10% approx.
Yeah. So like I said, see, it's a more aggressive product. If you are with a hybrid long short, which is like a BAF plus, in that kind of a scenario, I think you will be falling 20 to 40% of the downside, which could be like a 5 to 8%, because the risk itself is lower in that kind of a product.
Okay, sure. And already the NFO is running until next week, I'm right? The new fund offer.
Yeah, till May 11th.
May 11th. Okay, another 9 days to go. And one thing I saw in this product is you are offering STP, SIP, everything.
Yeah. So you will have everything. See, it's a very good product where you can do an SIP. The reason I said, like I explained earlier, timing matters very significantly when you are in a MF kind of a product, right? Because if you are investing at the peak, your IRR will itself look lower, right? And in this kind of product where the risk itself is managed by the fund manager, what happens is that an SIP works very well in this product, because your IRR looks better, because when valuations are at the peak, we are reducing the risk, and when valuations are cheap, we are increasing the risk. So automatically your risk management is way better if you are in this product. Obviously, we have all the things, STP, SIP, and everything is allowed in this.
Okay. Also, I didn't see SWP. Is there SWP or no?
SWP was there in hybrid long short, but I think our team will talk about, or the sales team can explain more on the SWP part.
Okay. Thanks for all those details. So the session was more about creating awareness about the SIF product, and it was great. Probably there might be some questions from the audience. Probably let me ask everyone, if there are any questions, please put in the chat box so that we can ask Suraj to clear your doubts. Whatever may be the question related to this SIF session, please put it in the chat box, and we will, he will try to clear your doubts. We have some more time with that. What is the minimum period of investment advised? What is the expected rate of return? what is the risk level, especially for senior citizens, 62 years? So, you have already mentioned that the minimum period of is 3 to 4 years for this product, and you have another hybrid long shot. How and what is the minimum period that you suggest?
Here also we have a like a BAF kind of a product. Minimum time horizon itself is 3 to 4 years. For that product also we have a similar time horizon.
Okay. So then, what is the expected rate of return? You mentioned Nifty plus 3%.
Yeah.
What is the risk level, especially for senior citizens, 62 years? Depends on individuals. Now, if you have some comments, you can tell Suraj.
See, like I said, if you are investing in markets, Nifty volatility is around 14%. If you are in a flexi cap, multi cap, large cap, your volatility itself is around 14-15%. So this kind of product will give you that 11-12% volatility, which is way lower than what a Nifty has. So in that way, you have to see how it fits into that, the risk level for the person. But like I said, if the person is invested in a pure long only product, then or a mutual fund, large cap, multi cap, flexi cap, this is a better product because it is able to reduce that risk for the investor significantly.
Great. Then Lalita madam is asking, any minimum investment required?
Any minimum investment requirement? So yeah, so that is as per the SIF category. You need to minimum invest 10 lakhs, and then after that, it's a normal SIP.
Yeah, but if they have already invested at 10 lakh, they can add any amount in this fund.
Yeah. If, for example, in hybrid long short, you have investment of 6 lakhs or 5 or 10 lakhs already, then in that case, I don't think you need 10 lakhs minimum. You can do as per, your.
In a given fund house, total SIF investment should be minimum 10 lakhs. So first time when you are entering 10 lakhs, subsequently any amount in any other fund or the same fund should not be a problem. What is the Swarna Ganesh? Swarna Ganesh is asking, what is the alpha you are thinking you will be able to make?
The alpha, if you look at versus Nifty, like I said, we'll be doing a Nifty plus 3% over a 3 to 4 year period, and that is what we'll set the target for. But as I said, the objective is on a better risk-adjusted return, so you have to also look at the volatility, which will be lower than Nifty.
Correct. Why these questions are coming is generally when SIF was announced by SEBI, people thought that they can make much more money than mutual funds because you can go naked short, all those things.
So yeah, I'll break that up for you. The thing is, if you are in a bull market, for example, the maximum net equity I can go to is the 90 to 100% or 100%, right? I cannot take leverage in this product. And a similar mutual fund product, be it a large cap, multi cap, flexi cap, or a mid cap, small cap, they can also go to a maximum of 100. They cannot go to more than 100. So you can understand on the upside, no, automatically what happens is we are also limited to 100% equity. They are also limited to 100% equity, right? It is on the downside which we are able to go lower, right? Versus the mutual fund product. And as a result, that is what I keep on saying, the downside protection, because you are able to reduce that net equity when the risk is higher. Right. But the thing is, when people say that it will give a better return than mutual fund, it will give. Because see, if you do the math, if markets are up 10% and you generate 9% and markets fall 10%, but you fall 5%, you have automatically beaten the market by 4-5%. Right? Because you are falling less. That is also an alpha. Right? And that is what it will show over a 3-year period.
Okay. Overall, when they look, after 3 years or after 4 years or after 5 years, you might have made better returns than mutual fund. That's what.
Yeah. So that is because we will fall lower. That is what the objective is, right? And let's not compare the product with mutual fund in a bull market, because mutual funds are made for the bull market, right? This product is made for the market cycle, where you are able to navigate the volatility of the markets. Markets are not linear. That we have seen over the last 3 years, right? So in that kind of a market, this kind of product, does very well over that entire market cycle.
True. And also, whenever, say, like if I have investments in mutual fund, and let me say I have investments in SIF, when market is up, very, very high, and I need money, I can pull out from mutual funds. When market is down and I need money, I can pull out from SIF.
Yeah. See, because on the upside, it will be very similar returns.
Correct. So on the downside, you might have protected. So
You can do lump sum in mutual fund at the bottom, obviously, of the markets. But you should do SIP in SIF.
Correct. True. So just a minute, let me mute everyone and then you can unmute, Suraj. Now, there is one more question from Manivasagam. Compare it with flexi cap return. What is the, okay. So, Suraj, the question is compare it with the flexi cap return. So with the flexi cap mutual fund, your returns will be a little higher. That's what you mentioned.
Yeah, so like I said, FlexiCap already beats Nifty by 2%, right? If the markets are 12%, FlexiCap is 13-14% over the last 10 years, if you see. Whereas, as I said, this product will give you that 14 to 16%, but with a lower volatility than FlexiCap, because FlexiCap has a similar risk as Nifty, which will be around 14-15. So it's a very simple maths. If, for example, FlexiCap is giving you 14% return with 14% volatility, what is your risk-adjusted return? It is 1, right? Return by risk, right?
Yeah.
And if you have a 15% or 14%, 15% return on equity long short with 11% volatility, your risk-adjusted return is, you can divide return by risk, you'll get 1.4. So that is how you have to look at it.
Okay. Not only on returns, but how much risk I'm taking. I'm taking lower risk here with full return potential.
Because the investor is not going to call you in the bull market and say your returns are low. He's going to call you in the bear markets and say, why are you falling so much?
True. That is 100% true. What is the incremental investment that can be made after 10 lakhs? You can make even 1,000 rupees. Additional minimum investment similar to mutual fund, this particular product. So minimum even 1,000 rupees you can make. That is Manivasagam, question from Manivasagam. And then NFO minimum investment along with other SIF. NFO, if you are investing in Tata mutual fund, titanium SIF for the first time is 10 lakhs. If you have already invested 10 lakh, here you can invest 50,000, 25,000, 1 lakh, any amount in this NFO. Then Suresh Kumar, what is the difference between SIF and PMS? I know that the minimum investment in PMS is 50 lakhs and it is 10 lakh in SIF. Other than this difference, what are the differences? Which one is better if a person can invest rupees 50 lakhs?
See, the thing is, if you look at a PMS now, you are only playing the bull market like a mutual fund, whereas it is more aggressive than a mutual fund, right? And the thing is, if you are under mutual fund and regulations and taxation, the taxation is way superior if you are in a SIF kind of a strategy. Plus, you don't have capital gains if you are, doing any transaction, which in a EMS, you have that taxation, capital gains. So that is a big advantage because you are under mutual fund regulations in SIF, which a PMS is not, right? Which automatically saves you 1 to 2% annually of the, from the taxation perspective. So I would say, it depends on the risk profile of the investor. If he's willing to take a way higher risk on the equity, obviously, you can be with a PMS. But if he wants a better risk-adjusted returns over a period of 3-4 years, where he's able to generate a Nifty plus 2-3% return, but with a lower risk, now you can compare it with the PMS with which he is investing and look at what is the output versus Nifty. I think then SIF is a better product, right? But like I said, PMS is all about how much risk capability you have. If you have that risk capability to take, then you should, take that equity risk in your portfolio. But if you want to have a much more risk-adjusted returns, manage the volatility better over the market cycle, and SIF will play that role for you very well.
True. I mean, one more thing is, say, like when you are playing derivatives in the portfolio, it comes at a 12.5% taxation. Whereas the investor, when he himself buys futures or option anything, it comes at a higher taxation.
Yeah, it is treated as a business income. So your taxation goes to 40% in that kind of a scenario.
Yeah, true. So that way, I mean, for completely pure long only, as you said, PMS is okay, but I want kind of the same return with low risk, SIF is better. Then Ramesh Varna, what are the best SIF funds for low risk investment? I mean, we can't talk here about best fund or anything, but what we can say is balanced long shot. This is the more equity long shot, which is the hybrid long shot. Even Tata Titanium has, and the same Suraj Nanda manages. So hybrid long shot funds are, for better for low risk investors. Kalishwaran, India Mutual Fund for UAE resident, tax is nil. How SIF will be charged tax? Same fashion, SIF taxation is also similar to mutual funds. So for UAE resident, it is nil. Either you have to give the forms in advance or they will deduct, then you have to claim, whichever way. You have to obtain permanent residency certificate in UAE, all those things, formalities are there. So the taxation is same as mutual fund. Then Sarvesh, sir, why the minimum investment is kept at 10 lakhs, which is higher for normal people to invest in SIF? I mean, Suraj cannot help with this because, SEBI, this is the government regulation. Since derivative is involved, they have kept this investment at 10 lakhs. I mean, earlier people were asking why the minimum investment in PMS is 50 lakh. So SEBI has to come out with the product. Just a minute, sorry. Just a minute, sorry. So, Suraj, you may have to unmute. So SEBI has set this limit. It is neither me nor Suraj or anyone else. So the minimum amount is 10 lakhs because some derivative is involved, and they want to restrict to more higher net worth individuals. That is the reason. Logesh, any lock-in period for SIF? Yes, they have a one. There is no lock-in period.
There is no lock-in period, but we have an exit load up to 1 year.
So one month, if I am right, huh? 1 month, 1%. If I am correct, I saw it.
Yeah.
So that is there. And Sampath Kumar, can the potential downside protection minimize the upside return?
See, like I answered, sometimes, you have to, there will be a gray period at the fag end of the bull market and at the fag end of the bear market where you will have to reduce the risk and increase that risk, respectively. When you are in the fag end of the bull market, you are reducing that risk. Like I will give you a very simple practical example. Like in 2024 post elections, July to September, the valuations were running very hot, right, in mid cap, small cap, or even in the Nifty. In that kind of a scenario, the models were telling us to reduce that risk. So we kept on reducing that net equity, but the markets kept on going up. So there will always be a 2-3 month period where you need to reduce that risk, because see, you can't tell ki I will reduce the risk after the markets have started falling, because then automatically the product itself is not going to give you the desired output. So you have to be slightly early in terms of either reducing the risk or increasing the risk. Again, I will give you the example in a bear market. For example, in March, if we would have not increased that net equity in hybrid long short during that March period, you will not be able to participate in the April rally. So like I said, you can't say ki I will increase the net equity after the market start going up. That cannot work. So you have to be always, follow the models, because that guide you very well. Because the human psychology is you become more bullish in bullish market, more bearish in bearish markets. So in that case, following that model which tells you when to increase or reduce net equity is a better way to manage the risk for the investor.
Correct. Okay. Then Lalita madam is asking, can I invest through SIP without a one-time investment of rupees 10 lakhs? if you are investing in Tata mutual fund, this titanium SIF, first 10 lakhs is necessary, compulsory, that is government mandated. Subsequent SIP can be for any amount of 1,000 rupees and above. And then Manivasagam, this will be the last question, Suraj. SWP in it only for the above 10 lakh or for total value of the fund. At any given point of time, you have to maintain 10 lakhs always. Say today you put 10 lakh and after 3 years it becomes 14 lakhs, just an example. So that kind of 4 lakhs, still 4 lakhs you can redeem SWP. But beyond that, you have to maintain 10 lakhs always so that SWP may not be able to work. And with that, Suraj, thanks for on a Saturday morning.
Thank you.
Joining and sharing your knowledge with all our subscribers. We will upload this recording in the YouTube as well. And thank you so much
for inviting me.
Yeah, thank you, Suraj. And probably we will meet next time when you are here.
Sure.
And I thank all the participants for taking time and to participate in this knowledge sharing session. Thank you, one and all. Thank you.
Thank you. Thanks a lot. Thanks a lot.
Thank you.